Well. Here I think we're missing one. Hans, are you here? Going once? Should I say going Hans? That's a bad joke. All right, so welcome to the most interesting session here at GMIC, Silicon Valley 2014. So a quick show of hands. Who's raising money? Raising money? Okay, that's your deal flow for today.
All right.
Took down names.
Yeah, all right. So I'm really delighted to be with this next generation of venture capitalists. Next generation, but they actually have been in the business for a while, so that's going to be interesting. Hans.
Good
to see you.
How
you doing?
All right, so welcome, Hans. Ready?
Yep.
So let's start with a quick intro from you guys about who you are and your fund.
Sure.
Go ahead.
So my name is Chi-Hua Chien. Hi, everybody. I'm the co-founder of a new venture capital firm called Goodwater Capital. We focus 100% on early stage consumer web and mobile companies. So we're focused on the stage where a product has been created and there are some initial customers, not a lot, but those early customers love that product, and now you guys are building companies in this stage. It now needs capital and support to grow. Myself and my partner started Goodwater earlier this year. Prior to that, I spent 7 years at Kleiner Perkins, where I was a general partner. I co-led our consumer investment practice there, made 22 investments spanning from early stage investments like Path, Clout, Everlane, Karma Science, to growth stage investments like Spotify, Twitter, and Square. Prior to that, spent 5 years at Accel Partners, where I invested in what we called vertical media properties, including Trulia and AdMob, which was in mobile advertising, and a little six-person startup called the Facebook at the time that we invested. And before that, I was on the operating side, was a co-founder or early employee of 4 startups spanning consumer-facing financial services, consumer apps, and advertising technology and enterprise software in the analytics area.
What's the average ticket size that you put?
Yeah, we actually have a fairly broad mandate because it's not about check size, it's more about where the company's at. Again, it's products that are launched and early customers, so we'll invest anywhere from $1 to $15 million into a company.
Okay, great. Doug?
Hello, everyone. I'm Doug Renert. I started out as a business operator and entrepreneur, ran a number of businesses at Oracle, and then did my own startup as founding CEO called Tello. And after that, I started Tandem Capital. That was about 7.5 years ago. And we're also early stage. We're kind of part accelerator, part fund. We look for great product teams working on mobile consumer software and hardware products. We look for stellar teams before they have product market fit, bring them into our quote program, work with them for 6 to 12 months, as well as invest capital in them and try to help them find that product market fit. And once they do, help them raise that next round. Oftentimes, the teams coming out of Tandem are raising good-sized seed rounds or Series A, kind of depending on how much traction they've got during that term. And we're trying to bring them to folks like Hans and Chi-Hua. In fact, GGV has backed two Tandem companies over the years. So, and then we'll have to get some to Goodwater now that they're in place.
Great. So how much do you invest usually?
We have a fairly large fund for being so early. We have our third fund, which is now what we're investing, is $100 million. But we start with small chunks. We invest $200,000 or $300,000 in the companies at the beginning. But by the time someone has gone through the startup has gone through the cycle, we can have $10 million in the business. So we set up the fund with that in mind.
Right. So $200,000 these days, that's not even seed, right?
We're basically pre-seed, yeah. If you think about when we get involved, it's pre-seed, if that makes sense. Yeah.
All the definitions have changed.
Right.
Yeah. I mean,
Valuation.
the seed rounds now that we're seeing can be $3 or $4 million, which is a little wacky, but they're still calling them, or they're starting to call those seed rounds in some cases.
Right. So if you guys are looking for seed, not below 3 million. Under 3 million, forget it. So Hans, you have one leg in Beijing, one leg in San Francisco.
That's right.
And so tell us about the fund.
Sure. GTV started in 2000. Historically has been more of a growth stage investor. These days is mostly A, B, and C. Selective in C with other co-investors that we like. Just the valuation is just too high. You got to move a little bit earlier. Most well known for early bet back in 2003, a little company called Alibaba. In the U.S., we're also a growth stage investor in Square, Series B in House, and on the enterprise side, Nimble and Zendesk. On the China side, we've been very active, not only investing in Series ABC deals, but also bringing in internet giants like Alibaba and Tencent and Baidu into our investments. I joined GTV about a year ago, and then before that, I was a early stage Series A investor in a little company called Xiaomi Mobile. And then
How's that going?
I think that they're selling a decent
number
amount of
two?
phones right now.
Device.
Yeah,
Are they number 2 now?
Yeah, number three.
Number 3.
In Q3. Yeah. And then since I joined GTV, one of my first investments is another company called Wish, has been growing extremely fast out of San Francisco, tackling the global mobile commerce space.
So it's just a great follow-up actually on the seed question. How are valuations today? I mean, it seems to be crazy. You know, seed today were Series A yesterday, Series A now. Just well, we had a Series A crunch. I'm not sure if we're still in it, but yeah, talk about a little bit of valuations today.
Valuations are much debated, but my theory on valuations is simply this. The best companies are always cheap when you look back at when you invested in them. And so, you know, on average, valuations right now are really high, but the difference between, frankly, a $4 and an $8 million pre-money valuation for a Series A doesn't matter a whole lot, at least in the category that I invest in, because in consumer, it's winner take all. And it doesn't matter if you had to pay twice the price to get into a company that ends up being the category leader. I think where valuations are potentially most challenging, and I'd love to hear Hans's take on it, is right now in the growth stage. Because of the structure of the capital providers that are now coming into growth, you have hedge funds coming into growth stage investing, you have public equity firms coming into growth stage companies, you have companies like Uber effectively executing public offerings with public market investors in a private transaction. And so the froth in that segment of the market can be pretty severe, and I think that's really where the valuation challenges exist right now.
Doug, that's pretty much the same.
Yeah, I mean, I don't stay up at night worrying about valuations, and I think in a lot of ways they work in the entrepreneur's favor right now, so they should take advantage of them. It can be a little wacky at the very early stages, because there is, and that's kind of your reference to the Series A crunch earlier. I don't think there's that much more Series A money out there, but there is a lot more seed and even incubation money than there ever has been. So you'll see some not so logical rise in valuation in certain cases on companies that haven't done anything yet. And I think as a early stage investor, you just have to decide if that makes sense and if you want to jump in, because you have almost no signals getting in at the stage we do. It's almost all based on the team, right? And then you just have to bet on whether the valuation actually is worth it based on the team. But hey, as an entrepreneur, you might as well take advantage of that. I also think you should raise. I mean, my philosophy on raising money is stay very nimble at the beginning, because you want as much flexibility as possible until you see the signals of product market fit, and then raise a lot because you don't know where you're going to be the next time you raise, and it is getting tougher and tougher to raise an A round and a B round. So you might as well have great investors around the table with plenty of capital before you have to, because you don't know when you're going to have to be out there again, basically.
Right. So Hans, one of the reasons of this high valuation on very early stage is coming partly from those outside investors, so foreign, China has a lot of money now, family funds are coming, Alibaba now has like tons. So are you seeing foreign investment? I mean, you talk about some of the big, large funds as well, but that, as a cause for those valuations to rise?
I think that has become more into caught attention of media, especially U.S. media these days. But if you look at what happened with some of the early investors, what is SoftBank 10, 15 years ago, or Tiger Global 10 years ago, and DST 5 years ago, it's the ones that can pay up the valuation tend to be the one that has a global view. They've seen investments happening in Japan, in Russia, or China, or other places, and see that whatever they're seeing in the U.S. is part of a very global phenomenon. Therefore, they're more willing to pay up to get in. I think in the case of Facebook, I know for a fact that before DST made the investment, they know that social networking is big in Eastern Europe. They know that you can monetize in China and Eastern Europe, $10 a user, and Facebook at 2.5 or $2 a user, there's room for 5x. So they're willing to pay the $10 million valuation. I remember at that point in time, people in the Valley, especially VCs on Sun Hill Road, all laugh at DST for doing something very stupid. And I think you don't have a global view in these days, it's very difficult to tell whether you'll pay up or not. Xiaomi in first round was 30 million posts, 4 guys and a very crazy idea. 5 months later, it's 150 million. Another 6 months is $1 billion. Every round you look at, numbers don't make sense. This is completely crazy. So unless you have a thesis of where you think things could go, you have a view of the entrepreneur who's been with them on several battles so that you think they can win, any normal person will walk away from those valuations and those metrics. And also what I've seen in China is that there's different way to fight in the emerging markets. When I went to China in 2005, the world had about 1 billion internet users. Now 3 billion. The net 2 billion ads over the last 8-9 years, 1/3 that came from China. So in 2005, Alibaba was worth 5 billion. People thought that valuation was high. Yeah. Baidu, when public in 2005, the price tripled in the first day, to $5 billion market cap. People thought the valuation was high. And Tencent, a $3 billion market cap, they say, well, Tencent's going to kill Tencent, a $3 billion valuation is too high. Now, one is at 80, another one's 180, and the third one's $380 billion. So the gap between the China and US has definitely narrowed. And that's why you look at India, a lot of smart money rushing in because they think that's the next big market. And India with smartphone penetration rate going up and more internet connection via smartphone, it should be a very huge market. So I think people keep on missing it because they don't understand why internet is a category killer. It's killing retail, it's killing software, it's killing offline world, offline economy in a lot of ways because it's so inefficient. So if emerging market is something you can get, even Alibaba today, $280 billion is cheap. If you can get internationalization, it'll be easily a $1.5 trillion market cap company in the next 5 to 10 years.
You heard it here first. So
quick, they're buying.
Yeah, yes. Well, the market is closed. Tomorrow.
They're buying options.
Yeah. The only thing people don't know is the macro. That's the biggest risk, right? But if you have the holding power, you don't need cash the next 2-3 years.
Wait for the next cycle.
So I mean, taking your idea further, then if you look at the broader space, a broader perspective. So what is for you attractive here in Silicon Valley? Is Silicon Valley still, the mecca of technology when you have this, all those the breaks and others to go shopping at?
Yeah, I mean, we bring our teams or find teams from all around the world because there are talented entrepreneurs just about everywhere. But we do require them to come here at least for the 6 months of the program because and there are a few exceptions now popping up, but this is, I still think, the best place to at least learn how to build a startup and start building a startup. But it's not the best place necessarily to grow the whole company. So a lot of our companies, they've come here for 6 months, immersed themselves in the culture, met a lot of people at the Facebooks and Googles and so forth, but they've built their teams back wherever they're from. You know, we've got teams from China and India and all parts of Europe. And it tends to be easier to grow organizations there, cheaper to grow organizations, and particularly if you've got a global business, it may not make sense to have everybody here anyway.
So keep
we
your
really,
R&D.
at least the R&D. If you're from, I mean, it doesn't have to be even outside the U.S. We have teams that have come from Texas and New York and parts of Canada as well. But
that's kind of out of the U.S.
It is out of the U.S. Sorry,
It's its own country.
Exactly. But yeah, we like that model actually. But we still do. I mean, we're selfish about it. That's we're here. We don't want to fly everywhere all the time. So that's part of it is come to us. But we do find the immersion in Silicon Valley, at least to kind of understand how startups are built here, it still has a big benefit.
Right.
There's certainly value to the ecosystem.
Right.
I think if you take a look at 10 years ago, people would have said that Europe would have been the center of mobile application innovation because of Ericsson, Nokia, 3G penetration, the use of texting, the penetration of kind of pre-smartphone era phones. But then Apple launched iOS and Google launched Android, and the velocity of innovation being part of that ecosystem here in Silicon Valley completely outpaced what existed in the rest of the world. I think there are similar ecosystems in China, potentially some forming in Europe, but the rate of acceleration that a startup can achieve by being here in Silicon Valley because of the culture, because of the know-how, because of the capital availability and the kinds of people that are available to you are substantial. I think what is changing though, and I'll use, here's an interesting example. Just recently we looked at our portfolio. It's a very young portfolio. We closed the fund in July. We had warehoused some investments, so we have a total of 5 investments in the firm right now.
What's the size of the investment?
It's a $130 million fund. And so we have 5 investments. None of the 5 are started by American-born Americans.
Right, that's a good point.
And so 3 of the 5 are located in the Bay Area. 2 of the 5 are located on the East Coast. But what's so interesting about these 5 entrepreneurs is they are all global citizens. So it doesn't matter where they live and where they work. They think globally. So their go-to-market strategy, their sourcing strategy, their hiring strategy, their branding strategy, it's all global from day one. And so I think that's the essential ingredient in our opinion. It's not the location, it's the mentality.
Right. Although if you're at Apple, for example, you want, or Yahoo, you want all the employees in sort of one central location. I mean, even working remotely it's a remote idea at those companies, for example. So.
I think Apple and Facebook and Google, they're one of a kind. That's great. But over the next 10 years, I think you'll see a lot more companies that's mobile first and global first. When I look at Wish, the 2 co-founders, one came from Eastern Europe, another one came from China. They've been in North America anywhere between 10 to 20 years already, rose through the ranks through Google and Yahoo, so very well trained, knows the American market. But at the same time, because they came from emerging markets, they really understand how to leverage global resources. And look at, Sequoia historically have done really well investing in first-generation immigrants or children of first-generation immigrants. And I think that's going to be even more key over the next 10 years. Because where's the 4th, 5th billion internet users going to come from? It will be Indonesia, India, Brazil, Africa, Eastern Europe. So you got to have people who are globally minded. And the way to play that growth, it may not be just the local teams, but also teams in China or teams in Israel, teams in the US that have a global view and can build businesses that tackle those markets.
Okay. So the panel is titled Disrupting the Venture Capital. So I'd be interested to know why do you think you guys are disrupting venture VC market, and when you have companies like 500 startups, Dave likes to call it the Walmart of venture capital, or you're gonna have crowdfunding soon coming next year. So just a few thoughts what you guys think are disruptors.
Yeah, I mean, I'll throw a few out. I think AngelList is I don't know that the VCs are disrupting all that much, but I'm sure there are some. But I think there's non-VC forces that are disrupting how tech companies can raise money. Right? There's AngelList, as I said. I think is a pretty powerful tool for early stage startups to raise money in cases where they couldn't necessarily beforehand.
For those who don't know AngelList, can you just kind of explain how it works?
Yeah, I mean, AngelList is basically a web community like LinkedIn, but for investors and founders. And founders can put their profiles up along with the profiles of their companies, explain when they're raising money and how much and the details of their business. And investors can discover those opportunities, share them with other investors, and there's different ways you can tune it, but there's some level of transparency as a company is raising money around how much they're raising, who they're raising it from, and that combined with some other regulatory changes has allowed a large number of smaller investors to play a pretty active role in backing startups these days. So I think that's been a pretty disruptive force. I've got some others, but I'll let these guys mention
if you guys are not on AngelList, you should sign up.
I think Kickstarter is probably the most substantial innovation in the funding of consumer technology hardware in forever. The problem with consumer technology hardware for a long time is folks like myself are primarily software investors, and we don't want to fund inventory. And so it was really, really hard up until Kickstarter for somebody with a new hardware idea to get funding. You might have someone like Hans willing to write you a check for Xiaomi, but to be honest, that's few and far between. Most people want to fund software. And Kickstarter is an environment where you have a great idea, and literally all you need is a good video set to some catchy music, and you can raise like 10 or 12, or that ice box raised like $13-14 million. Right. It's unbelievable.
I wouldn't say all you need, but
I'm vast oversimplification.
There are some crazy
but that's a substantial innovation, because what it enables a venture investor to do is mitigate product market fit risk, because there's no way that any of us could have forecasted that a new ice box or a new, what do they call it, the coolest cooler? A new cooler could have attracted that level of demand. And so that enables us to then go in and fund the company building process, which equity is used for, while Kickstarter is funding inventory.
Right. Crowdfunding, you think it's going to change a lot? I mean, Kickstarter for the hardware side, but now crowdfunding open to everyone that can.
It's great for the innovation system. It's good for the VC business as well.
Why is it good?
Because it's more
expands the funnel.
Exactly, just expand the base of the funnel. So more crazy ideas, more kind of who knows if it will work, but kind of interesting kind of stuff gets funded. Then we can come in and decide whether we should invest more. I think in VC business, the further it gets, the bigger the companies get, the more crazy the valuation, the harder it is for the general masses to invest. So I think at the early stage, the more can come into the ecosystem, the better it is for everyone else who invests afterwards.
I would question the premise of your statement that venture capital is being disrupted. I think that's a catchy headline to talk about these forces being competitive, but in reality, like what Hans is saying,
headlines
when you guys love headlines, but clickbait. But technology has always broadened the market opportunity. You drive the cost down, you increase accessibility, and the market opportunity increases. So essentially what crowdfunding is doing and AngelList is doing, all of these mechanisms, they're allowing more entrepreneurs to pursue more ideas, which simply creates a larger opportunity set for company building. And if you look at Y Combinator, 130, 140 companies a year, 10 years ago, 95% of those would not have existed. Right. But now, 30, 40% actually get substantial funding to go pursue a market.
And there's about 500 Y Combinator followers, clones. So you multiply that out. And by the way, I will also say, Kickstarter is not the only platform for crowdfunding hardware or anything else. Like we with some of our companies figured out that the most powerful crowdfunding platform is actually Facebook, like it is powerful in other areas, because you can use Facebook to advertise, get the message out on when people are getting interested, and you basically just use that as a elevation platform. And so one of our companies, Tile, which is also a GGV company now, they started out, they didn't use Kickstarter, they built their own little website, and they just launched on Google, YouTube, and Facebook, and did, I don't remember the exact numbers, but $10 million of sales in some number of days. And it was better than Kickstarter because they had more flexibility. They got the money up for Kickstarter, holds on to the money the whole time. They could take that money and reinvest it in their advertising. But yeah, like we were talking about, what it enabled them to do is, and this was all on $200,000, they went out for their seed round having already had $10 million of revenue, or pre-revenue really, but $10 million in bookings out of the gates. And that's awesome. Yeah, and that's a hardware company that did all that on $200,000 and built their brand profitably. That's another thing you never used to be able to do. Building brand was always the most expensive thing for, well, not just technology companies, any company. Yep. And now with these new technologies and platforms, you can actually build your brand while you're making money. And then when you go out and raise money, because you might want to take a big step up and build out a manufacturing line or whatever, you can do so at much higher valuations than used to be the case, which means, hey, the entrepreneurs at the end of the day may own 50% of the hardware company as opposed to 10% or whatever used to be the case in the
traditional. But does the rise of crowdfunding site, does it actually hurt those early stage investors, because then they get a bit squeezed between maybe the angels, the crowdfunding side, and then the GGV of the world where they can
I think for any investor, you have to have clear, differentiated value at whatever part of the ecosystem you're in.
That's a great segue. What would be, when you pitch a startup, what do you say about,
Yeah,
taking your money?
We take a very hands-on approach to finding product market fit in mobile and hardware. Right. Mobile software and mobile hardware. And we have to show the resources we have available and have them talk to the entrepreneurs we've helped in the past. But we have to basically build our business on that premise and on that value proposition. But I think everybody needs one, and whether you're at the earliest stage or you're the latest stage investor. So otherwise, you're not going to get the best deals.
What's your premise?
Yeah, so Goodwater is 100% focused on early stage consumer technology, and our learnings, I came from Kleiner Perkins, my partner came from Maverick Capital, both very large, successful, but diversified platforms. Our learnings were that at those large diversified platforms, consumer tech is something that is not often well understood by partners who also invest in enterprise software, life sciences, or network infrastructure, or security software. And so you're kind of like the three-eyed cousin walking in there with a deal that has no revenue, has like teenagers using it, and people wonder if it's ever going to make money, right? But consumer represents close to 90% of all returns in venture capital. It's a stunning proportion of returns that are in consumer technology. So we've built a firm that is 100% focused on getting you from having a product to scaling your organization and your customer base globally. We have two main pillars for how we think about adding value and differentiation. The first is knowledge. We're building a software platform which essentially monitors consumer trends globally, understands how applications and websites and products are performing relative to their competitive set, and how market sentiment might be evolving relative to different markets and products. And the second is network. We've assembled a world-class network of some of the best consumer technology operators and advisors and entrepreneurs, people who have day jobs, people who you can't recruit into your company, but they are at the absolute top of their games, and they will be your advisors on our behalf, and we will bring them to bear on the most important scaling challenges that you have in your organization.
Great. Hans, what do you bring aside from lots of money?
I think that's a question I get asked
That's
a lot.
already a good thing, but
Especially from media. I think what people most miss is that most of the time what entrepreneurs do, if they're disruptors, they're doing stuff that 80, 90% of people just don't get what they're doing. So most people would look at it and go, yeah, this is just a stupid idea, forget it. And that happens 80, 90% of the time. So it's not as competitive as people think it is. I remember talking to Wish. I haven't met everybody on Sandy Hill Road, but he's selling stuff from China to young users in Alabama, Louisiana, Florida. What's so interesting about that? I want to invest in companies that have great brands and work with great brands and have users in New York and San Francisco that's so much sexier and so much aspirational. And that thesis is wrong. You haven't seen any company that in that kind of thesis come big. But we have seen how Taobao do exactly the same thing Wish was doing 10 years ago. Now it's a $280 billion company. So, you guys, I get what you're doing, and I think what you're doing is right. That's number one. Number two, we've seen how companies scale. 18 of our last exits have exited over $1 billion valuation. We went in at about 50 million. So we know how to get to 20x and what it takes to get there from strategy, BD, product, team building, etc. So we're going to help you to do that. And you want to source from China? Do you have a team in China? You don't? Great. We'll be happy to help you to recruit the team in China to do it. We've been there investing for 14 years. We have the resources to help you in a particular category. You want to figure out a way to talk to some strategic partners who may give you additional traffic or things, whether it's Tencent, Baidu, Ali, we've worked with them before. We can do that. In the US, we talked to a Chinese company. You want to access the US market, whether it's talking to Facebook, Twitter, and Amazon, Google, LinkedIn, we have access to those too. You want to advertise on those, we have people who can help you. So if you're in a sector that you want to invest and you have the resources up and down the value chain, you can be quite helpful to the entrepreneur. Not only do you get them, you can actually help them. So if you have concrete examples, it doesn't really matter who else is around the table and how much money they have. Granted, you can't give, trying to get in a deal at 50% discount, that would never work. As long as the price is competitive and you understand how big the company can be and you're willing to pay the price that's reasonable, I think it's a pretty good, interesting game.
Okay. You mentioned exits. In the mind of entrepreneurs, a lot of time is, who can I sell to? How's the IPO market, M&A? How's that pretty much, is it very active?
The IPO market is fantastic right now. It's probably the best it's been in 15 years. So if your company has the financial metrics necessary to get public, now's a good time to get public. I think the M&A market is healthy, but we're about to see it become a lot more active. So we recently did an analysis that looked at all the cash balances for consumer internet companies globally. And if net of the platform guys, there's probably about $260 to $300 billion of cash across 27 companies in consumer internet.
Yep.
If you add in Apple, Microsoft, and Samsung, the OS and handset makers, you're talking about north of $600 billion of cash.
That's a lot.
Sitting on the sidelines. And think about it, the reason a company has cash, by and large, is because they can't find opportunities to invest that cash back in their business as quickly as they would like. So they're looking for new opportunities to grow.
And that's you guys.
That's the companies that you guys are starting, right? So a lot of people looked at Facebook paying $1 billion for Instagram and thought it was crazy. Doesn't look so crazy now, right? YouTube getting bought by Google, that doesn't look so crazy now. Android getting bought by Google. Facebook recently paying $22 billion for WhatsApp. Probably some of you out there still think it's crazy, but if you kind of do the math on the back of the napkin, you can see how owning the next great messaging platform could yield far more than $22 billion of value. So I think we're about to enter a period, actually we're going to publish a research piece on this in the next few days. We're about to enter a period where we're going to see rapid global M&A. And I think the other interesting thing is a lot of that money sits in Asia. A lot of even the US companies' cash is in Asia right now in subsidiaries that they can't bring back to the US without severe taxation. So a lot of that activity, I think, will be biased towards Asian companies either investing aggressively in the US or making acquisitions to grow their business overseas.
I think with the Asians, especially Chinese internet giants, they don't always do M&A, even though that's one option, especially for investments beyond China. They tend to do strategic investments. They have what GGV we call the kingmaker strategy. They pay category leaders either number one, number two. They put a lot of money in a reasonably high valuation for a minority stake, and then figure out a way to grow that business with that company, because they know that they cannot manage a business outside of China as easily. Xiaomi is one of a few exceptions. Therefore, empowering the team to do whatever they need with resources from China and money and so forth, they think it's much better to grow the pie together. So that's a different way than a Google, Facebook will compete. So I think the next 5 years will be extremely interesting.
So, I mean, you guys are painting almost a perfect paradise for entrepreneur. I mean, it's so easy. You just have to, bend and you
Just scoop up the gold.
Yeah. So I'm talking to a lot of entrepreneurs, and they're telling me, it's hard to raise money. So there's a disconnect. So how can they, get to that promised land where there's just like tons of money everywhere? Do I have to go to Asia?
I think the macro is very strong, but I don't think anybody would ever say that entrepreneurship is easy. Entrepreneurship is and should be the hardest thing you've ever done, because you're pursuing an impossible dream with very few resources, and you're expected to do more with that than you can possibly imagine, and you'll have less resources than you hope for. Right? So just to be clear, I do think, however, that the opportunity set that we're facing today is an extraordinary opportunity set. And don't be discouraged that fundraising is difficult, because that's a refining process that's going to make you better. Me personally, we were on the road fundraising this fund for 3 months over the summer. Our business plan and our strategy and the focus level that we brought got better with each successive time that we had the opportunity to tell the story and had to answer hard questions from very smart people. So as an entrepreneur myself, who just started a firm, albeit in a slightly different category than what you guys are doing, I'd encourage you to look at this as an opportunity to learn and get better, because it'll make you stronger for the future road that you have ahead.
All right.
Yeah, I think another key is just to be self-aware of where you are and where your business is, and try to line your goals up with that, right? I mean, if you're just starting something and you have a PowerPoint, going out and trying to raise even a seed round, let alone a Series A, may not work. But the beautiful thing is, now there are all these opportunities out there at every tier, right? I mean, there's, like we just said earlier, there's Y Combinator and hundreds of clones, and some of them are very good routes to kind of start the journey. And then we talked about AngelList, all sorts of avenues, and as long as, you might want to stretch a little bit, but as long as you don't stretch too much, hopefully there's an available funding source that's the right level for where you are. And we had to do that at Tandem. When we started Tandem, my partner and myself, we had never run a fund before. So we had a lot of skeptics. So we started with a $10 million fund. And we proved ourselves, and 3 years later, we raised a $33 million fund, and then 3 years after that, we raised a $100 million fund. But we had to kind of be self-aware and just gradually get to where we are now.
So Hans, the last word. We're out of time, but
I will argue that Asia is much tougher than here. VCs who invest in Asia, I travel to China once a month. I know guys from Tiger, from New York, go to China once a month. DST go to China once a month. And people living here in Dubai and Hong Kong. The entrepreneurs, any category pick in China, there are 10, 20 companies get funded doing almost exactly the same thing with very similar business model, minor tweaks, and just attacking each other. I have seen portfolio companies that had competitors order their product and then return them to cause them problems, or stealing company secrets post them as employees and leave them for 2-3 months. All kind of have happened. And that's why if the company that can survive all of that and still be big, like Alibaba has done, and Jingdong and Xiaomi, they could be extremely competitive on a global basis. So it's going to be very interesting in the next 5 to 10 years.
Okay. So here you have it. That was the best panel here at GMIC 2014. So just after the opening of the market, just go buy some Alibaba shares. If that
You heard it here. It's going to do a 5x in 5 years.
exactly.